Today we're focusing on the S&P 500 only, given the material changes we've seen in the charts just over the last few days. So let's get started with the pattern work, of course, because this is what we base our analysis on every single day at CappThesis. And needless to say, there has been a big change, and we can see it first on this 2-hour chart. And we've been tracking all of these patterns along the way, again, very short term first. And needless to say, given the advance we've seen over the last number of weeks, it's been one straight uptrend line. But remember, those uptrends are created by what? Consolidation zones leveraged to the upside over and over again. And so this was the fourth and biggest one from this time frame, at least. And there were others, of course, which we'll review too. And so we don't get too concerned initially when there's a very short-term formation that's negated like this, but when it shows a complete change of what's been happening, it at least forces us to take notice, if nothing else, because as we know, momentum can feed upon itself both on the upside and downside. And so the biggest pattern that we've had in play, or at least the highest target over the last number of weeks, has been this bullish flag pattern, right? Very strong move higher, just a few days of consolidation in the middle of April. And then, of course, an immediate upside follow through, which led us all the way up to getting pretty close to it. We got up to within less than 1% of hitting that target just as June began. And so one of the best things we can have happen when there's a big upside target like this is that the market is able to create a cushion of which to pull back to and potentially form other formations within there without violating this area. And so we've seen this now play out, how important it is just over the last 2 days after that big 2.6% decline, of course, that we had last Friday. And so as a result, still in play right now, but obviously getting closer to being negated. And it's going to be very important to see just how well defended this, say, 7,100 area is if and when we get down there. So along the way, anytime there's a pause of bigger nature than we've seen, there's always a chance for potential patterns to be formed from both the upside and downside. So initially when this occurred, right around here, we had said that this could obviously take one of two shapes. Come back here, have a rally from this support zone or this proposed neckline, and if that were to fail, it would produce obviously a lower high. A lower high combined with the most recent peak and the high from May, obviously this creates a very clear potential bearish head and shoulders formation with a lot of air. Again, in here, this was that bear or this was that bullish flag, but near term, not much at all, right? And so at some point, that may become a reality. Now, on the other side, right, any buy effort that comes wherever it is that then shoots us back up to this high eventually, it then produces a higher low. What does that give us? A potential bullish formation. And we've seen this play out across various time frames over the last number of weeks, months, and years. And so the thing is, you never know when any one of these pullbacks is going to create a tradable low, but at some point we start counting or tracing out what that next bullish formation would look like. We saw it here, right? Initially, again, the bull flag, and then we just talked about how some of these shorter term ones as well. And so, when the market is in a free for all, at least in the short term, it's always price discovery mode, support discovery mode, and pattern discovery mode. And so we're still in that right now as this corrective like activity goes through. So a lot of these charts are as of the close on Tuesday, June 9th, but this is being recorded in the middle of Wednesday, June 10th. And so we've had the ability to update a few of them. And so far, it appears, of course, that the bearish formation is taking charge here. And if we were to get a close below this zone, this would make this bearish pattern alive and produce a downside target near 7,060. Now, if that were to hold, it creates an interesting scenario because it's just below by a few percentage points the 7120 38.2 retracement of the entire rally, right? And that lines up somewhat with that consolidation zone, again, that bull flag that took shape in the middle of April. So at some point, possibly relatively soon, we could be coming back down to a confluence of support, which of course we hadn't really had up to this point. That could be an area of interest from the buy side. Now, another way to look at this, right, because there are different forms sometimes, is that we can connect these lows instead and have a downward sloping neckline, right? And so that's, of course, when that happens and we get a downside break, because we're measuring from a bigger pattern here, the downside target will be larger as well. And so that would be right around 69.50. So again, getting closer then to the, say, 50%, 61.8 retracement level if it got to that point. The main thing to understand, of course, is that, again, all of this now becomes at risk just because of how consistent and how few stopping points there were along the way. So again, I think at some point we're going to identify a tradable low, and then we'll see if a real bullish pattern can be formed from there. But at the moment, we have to respect all of these. Now, we've seen bearish patterns come and go over the last number of years. Very few of them have played out. The ones that have, needless to say, those downside targets can be acquired very quickly, so we have to be on guard for that. So if you're enjoying this content, again, check out our free Cap Notes newsletter on Substack. Again, we put on excerpts from our premium opening look piece multiple times a week, and occasionally release full unlocked pieces as well. Recently, we were talking about, the bulls are looking for a better effort after the initial bounce attempt on Monday failed. Number of charts in here describing that, and we'll be talking about some of our more successful chart trade ideas as well, what they look like when we talked about them initially, how they played out as an example of what we look for every day, which we of course keep track live on the CappThesis website on the Chart Trades Live tab. To get a feel for what that looks like, again, check out capnotes.substack.com. Look forward to seeing you there. So turning to some other charts, right now we have two-way volatility, right? It's obvious it was one way on the way up, and now, of course, a lot different. And so we see this play out vividly here, right? January, very slow start to the year. In fact, by some measurements, the most narrow trading range to begin the year in quite some time. Things, of course, changed in February, more 1% declines. In March, of course, that's when things really heated up on the downside. And we see how many number of 1% declines with some 1% gains peppered in. Two-way volatility is always going to be accompanying a downward sloping market. And on the flip side, right, what do we have? Slingshot higher. We know there was 8 straight 1% gains without a 1% loss. That finally ended in the middle of May, but this was just very minor pullback with that 9-day winning streak happening in its wake. And of course, leading to the pullback which we're dealing with now to start June. Again, huge down move, right? 2.6%. As we know, it was the biggest decline on a daily basis since October 2025. And then with this effort on Monday failing and only producing a 30 basis point advance, it was clear it was an inside day. And of course, that was then met by yesterday's big decline and potentially one more today. And so as we can tell, all of this together, right, potentially getting more 1% declines overall, it just feeds into the momentum, right? At some point, this will change, but again, we have to respect it because, again, this was a huge move, as we know, one of the biggest 8 weeks, 9 weeks we've seen in quite some time. So we know that type of one-sided, very consistent market can only last for so long. It wasn't about if we're going to get a pullback. It was when, which is happening now, and now what is it going to look like over the near term. So bigger picture though, right? Same type of back and forth movement that we've been tracking for quite some time. Huge amount of volatility on the downside, sometimes even bigger bout of buying, a buying spree with slingshots to market higher. Once again, that happened, right? And just over the last few weeks, which was even more severe on the upside than we saw here. We had the luxury back in 2025 of seeing that then turn into a more consistent and long-lasting uptrend before things changed. Again, one of the biggest bullish patterns being acquired here back in October. And right now, of course, this has reversed pretty quickly as well. We know why, right? The semiconductors, XLK, so forth and so on, got really extended, right? So many times we talked about how extreme it was. And with that helium came out of the balloon, we knew it was going to be relatively fierce. Dealing with that now. So the concern from this angle is that a lot of this has to be retraced now. We saw these green arrows showing how the marginal breakouts, both in early 2025 and again, late 25 and 26, just gave way to momentum coming out and then obviously rolling over once more. This, not as much, right? This had been strong all the way through the end of May, and of course now being dealt with in very sharp fashion at the moment. So again, the hope is from a bullish side is that at some point it gets bought and we see some more consolidation take place before a much bigger drawdown happens. But there's no guarantees, of course, but we have to understand how this could play out from both sides. And so from a go-no-go indicator, that could be shifting soon because along the way, again, flipping back to bullish in the middle of April, and this tends to happen, right? We get a very strong move, market maybe slows down just a bit, creates these short-term sell exhaustion signals in the form of those red triangles. It just means that this indicator down here is just off of its extreme levels, coming off of overbought. That produces at least a pause, sometimes more, sometimes not. And so along the way, just like any other overbought indicator, whether we're looking at a MACD, a DeMark, we'll look at both of those in a second, we can see this persist despite sell signals. But on occasion, as things continue to get extended, one of these is going to work. And so far it has been the case. And potentially, after today's action, these weakening bullish bars from blue to green may flip once more to, say, amber here. When we saw that a few times along the way, of course, only lasting for a day or two from December to February before flipping all the way to bearish. So we may come in tomorrow morning and see that we have one of these transitional type bars once more. And from a weekly perspective, again, as we talked about, we have yet to see a bearish bar ever since April or early May 2025, where it got very close here at the end of March, of course, of this year. 2 amber bars quickly reversed and now, of course, been bullish once more. And so as was the case here, 2 sell exhaustion signals there did not matter so far. And it may coincide with maybe flipping back to at least weakening bar at some point as well. But, if we were just looking at this from a big picture point of view and it decided to remain in this trade for as long as these bars do not turn bearish, then we still be in this all the way from May of last year. Now, from a short-term perspective, things really got extreme, right? Went from being unable to get to overbought territory all the way back, from December of last year to finally getting there, hitting one of the highest levels ever on a short-term basis, looking at the 14-period RSI on the 2-hour chart, and then getting all the way up and staying there with the pullbacks along the way, only getting down to this midpoint at the worst, with every one of these mini pullbacks being enough to produce another set of buying, right? Of course, that really changed. Even though the market was moving higher, the S&P 500, it was doing so with weakening in momentum along the way, with this RSI making lower highs and now suddenly dropping all the way back down to 30. In fact, this was 26, which was among the lowest ever, with the bouncing attempts now being the ones that are failing to push back up to overbought territory, right? Becoming lower and lower. And so we're clearly in a completely different environment with the pendulum swinging all the way to the opposite side. And so this is what this looks like. Again, RSI hitting 26. And this was a chart we recently showed in our opening look piece, noting all of the times when the 14-period 2-hour RSI hit about 26 or lower. And along the way, when those happened after the market pulled back a good deal, those are good buying opportunities, right? October 2023 low, April 2025 low, and even at the March 2026 low just a few weeks ago, it all happened. But we've seen them also occur, right, as the market was still moving higher as well. Now, the one that we have to be concerned about is what happened at the end of this rally in February 2025, again, hitting oversold territory, but leading to more pain on the downside, right? And with this, again, coming off of extremely high reading, as we talked about here, right, 86, is concerning that, again, we have to maybe stay a little bit longer down in this area before getting back to extreme overbought levels, as we saw again from here, where some of these really high levels of the RSI, or the same short-term RSI, happened at the end of strong moves. And so breadth has been one thing that we've been concerned about, especially from the S&P 500 perspective, because just as it was starting to improve a bit from March to April, as the market was selling off, it's now obviously started to top soon after, right, the initial push in mid-April. As we know, that's when things really started to be focused on large cap tech leading the market higher, and some other areas really struggling. Started to see subpar breadth more often than not. Over the last few weeks, it didn't matter until it did, right? With the S&P finally at the end of May, early June, rolling over, even as we already saw that deterioration with the S&P 500 Advance-Decline Line, again, making high in April and making lower highs all the way through where we are right now. And so that has meant that recently, at least, over the last few weeks, the RSP equal weight ETF for the S&P 500 has been doing better, but it can only do so much if the entire market is rolling over. Now, one thing to consider is that yesterday, on June 9th, we had the best breadth day since April 30th, which was 74% of the S&P 500 rallying, even with technology, again, having a bad day. So, it's been good enough with most of those non-growth sectors stepping up when we need them to. The question becomes, how much more pain do we need to see in technology and large cap growth before it affects the entire market, before we see not only XLK say down 2, 3, 4% on a day with decidedly negative breadth for the rest of the market? Of course, that's when things can get really ugly from a momentum side. So far, that hasn't happened. The S&P again teetering right here near this level once more. And so we've been tracking DeMark a lot more as well, because as the market was getting extended, really wanted to get a handle on what those 13s potentially look like. And it was good timing because, as we know, along the way, the market was able to rally. But when we had those two, the TD sequential and the TD combo DeMark indicators, they came about 2 days before the market top was in. And again, after a 9-day winning streak, after everything else getting stretched, after that really extended short-term RSI reading, everything lining up together, and we saw the result. So we're continuing to track this as well every day now at CappThesis. Again, this is something that we do a lot. Look at different tools out there. We started to implement the GoNoGo work into the daily analysis. That has been a very good help on complementing the pattern work. And putting now DeMark on here, it gives us a very good idea when things are getting too extended to the upside, too depressed from the downside. Again, if that coincides with where we see the S&P 500 finding support, near moving averages, near key retracement levels, so forth and so on. We want to have access to as many tools as possible to keep us on the right side of the trend. So beyond DeMark, we of course track other indicators as well to give us a sense of an edge here. And so one of the things we looked at recently was the Bollinger Bands, right? Because the S&P from, of course, the low from March had been trading within the upper half of this band, right? The 20-day moving average is here. 2 standard deviations above is the upper band. 2 standard deviations below is the lower. And so, at some point we knew this wasn't going to last. And of course, over the last few days, it's come down and undercut finally the lower line. Now, we wanted to show this because the first time this occurred from the April 2025 low was this August 1st big decline, right? One of the only 1% declines we saw during the summer of last year. And it looked bad because at the same time, it was also breaking below a bearish pattern, just like it's doing now. And what happened? From that point, buyers came roaring back in and created this other up leg that, of course, persisted all the way until things started to go sideways once more in October to the end of the year. And so right now, does it seem like we're going to get one of those huge bids back because things had gotten so extended, especially from a large cap tech perspective? But remember, things can turn in the opposite direction just as quickly as we saw them obviously reverse just over the last few days. So we'll keep an eye on this. Again, if this pullback becomes even more severe, it's going to cause these bands to widen once more. The MACD has been a very useful tool even through 2025, when all of these sell signals proved to just give us whipsaws along the way. Because again, if we're looking at these mean reverting indicators, MACD, DeMark, so forth and so on, and they don't work, what does it tell us? It tells us that the trend is very strong. Dips are being bought, sell signals are being averted, and the market continues higher, bullish patterns continue to play out. And of course, the only time that really did not happen when actually sell signals played out was in November of last year, and then again in February, which of course we did a very good job of nailing that top, eventually getting us down to those late March lows. And so what was interesting about this first MACD sell signal that happened after a 20% gain from the low, which was very similar to the April to May run from about 24%, first MACD sell signal came as well. And we see, how much of a huge move the MACD indicator lines or those moving averages had along the way, right? And so eventually just having to pace slow would create this sell signal, which it did. And then what happened, of course, is it continued to move higher, and we got a lot of these whipsaws along the way, but with the MACD lines themselves kind of staying relatively consistent, even though they were moving lower ever so slightly. Right now, same type of thing happened, at least initially in May, right? Where that first MACD sell signal produced a minor pullback. We saw those lines cross, made new highs. The indicator did not. And of course, now with the pullback being over 5% from the high, we will call this a successful one. So much different from here. Does that mean a much bigger decline has to happen when we have the complete reversal with the indicator moving all the way lower? We shall see. The point being is that the selling effort now is happening sooner and is more severe than anything we've seen or we saw in 2025 at this point, and we have to respect it. Best case scenario, again, because we're still in price discovery, support discovery, and pattern discovery, is that one of these points becomes a workable bottom that we can then trace out the next real bullish pattern. Until then, check out the other videos we have on the channel, and talk to you again soon.